Welcome to this session. This is now the second day of Patsita's conference, focusing on the aspects that keep us awake at night. In this session, we will be looking at impact investing, the why, the what, and the how. We all believe in impact investing is important for both our members, beneficiaries, as well as for our country. More than ever, institutional investors are facing decisions that could alter the sustainable development of our country, as well as the potential financial returns that we can offer to our beneficiaries. We need to know what impact investments are. We need to understand why this is important and what solutions are available to us at boards of trustees. Just a few housekeeping rules. To make the session easier, we've divided it into two parts. After the first three speakers, we'll have a short Q&A session and thereafter a short comfort break. We will then welcome back our speakers, another three speakers for the remainder of the session, followed with a final Q&A session. As this is a plenary session, your microphones will not be live. Please use the chat box or the Q&A section on the right-hand side of your screen to raise your questions. These will then be posed to each of the speakers at the end of their session in the Q&A section of the presentations. Without wasting your time, I'm going to introduce Monica Krause, a senior consultant from RisCura, Jason Lightfoot, and Asmira Mula. Welcome to the stage, guys. Over to you, Monica.
Thank you so much, Yvette. Allow me a minute just to share my screen. All right, and with that, a very good morning to you, ladies and gentlemen, and thank you so much for being here today. I'm absolutely delighted and honored to be presenting to you today and also to be presenting alongside some of my top industry colleagues from Futuregrowth, from 91, and my colleague Glenn Silverman in the second part of the session today, who recently joined RisCura. So I've got the honor of talking to you a little bit about the what, the why, and the where to from here, really just to set the scene. And all of the presenters that will be after me really just will just bring so much more flavor and conversation today. If there's one thing that I can already upfront request, or my wish for you to take away from my session today, is really about the impact, and that impact is about the real economy. It is about the real economy in South Africa, and how do we go from here to invest with care in this real economy. So what is impact investing? They say that a picture speaks 1,000 words. Several pictures speak 1,000 words. If we look at the screen that is in front of us, that is our economic reality. That is the reality of many people in South Africa today. This is the impact. This is the economic reality that we are talking about when we are referring to impact investing. It's to transform from this and to create a reality that looks like this. That really is impact investing. And in case the pictures weren't clear, we can chat a little bit about what is it that South Africa struggles with. Low business and consumer confidence. These are all things that we know. Low economic growth, high government wage bill, increasing tax burden, increasing debt levels, decreasing confidence in the economy, decreased investment from overseas, state capture, corruption, underinvestment in many, many key areas where investment is so desperately needed, and a formal market that is shrinking. The formal market, the listed markets that are shrinking, less investment opportunities, and those markets not being South African. A lot of revenue from the listed economy is generated offshore. This focus on impact investing, again, it's about focusing and refocusing on the real economy and how we can invest with care in our South African economy and our South African reality. So let's just unpack exactly what is meant by impact investing. The noun impact is defined as a marked effect or influence. And that's exactly what impact investing is. It's a marked effect or influence, something that generates measurable, positive social and environmental impact, something that facilitates social, environmental, and economic development, and importantly, delivers a competitive financial return. And you'll hear me say that a few times in my part of the presentation today. This is not just about the social and the environmental impact. Of course, that's the key focus, but very, very strongly, the focus is also together on creating the competitive financial returns. So if we look at some of the key elements of impact investing, the four main ones: intentionality. It's about intentionally contributing to social and environmental solutions. This is different from ESG and responsible investing in part, and I'll unpack that in a couple of slides' time. Financial returns. I've mentioned to you, I will say this quite a few times in today's presentation. It's about generating a financial return on capital. It's not philanthropy. This is not charity. It's about doing good and creating financial returns at the same time. A range of asset classes are available. I mentioned very briefly to you that the listed markets are shrinking. The listed markets are offshore to a large extent. This is about a range of asset classes, including private equity, private debt, fixed income, etc. And then it's about measuring the impact. It's about how do we actually go about and measure the impact that we are having, and then reporting on that and tangibly seeing the results of where we are having an impact. I'm going to focus a little bit more on the intentionality and the financial returns in my part of the presentation, and I'm sure through all of the other speakers that we've got in today's great session, you're going to hear a little bit more about asset classes and impact measurement as well. So first and foremost, let's focus on the financial returns. We spoke about the impact being about delivering competitive financial returns. For those of you who've been in the industry for many years or who have been involved in ESG for many years may know, and for those who aren't aware, that in the early days, ESG, or environmental, social and governance and responsible investment, it was quite a tough concept for many people to wrap their heads around. It was tagged with perceptions of charity. It's about the sacrifice of returns. It was seen as a tack-on strategy, just something little that you needed to, throw into the portfolio so that you could please the greenies, for want of a better word. Since then, there's been an emergence of plenty of evidence to the contrary. It's not just about the green. It's about making a difference and generating returns at the same time. And similarly, impact investing may have, and actually may still be facing similar skepticism by some, that it's all about the feel-good factor and it's all about giving up returns. There is significant evidence to the contrary that supports the investment rationale. And again, I'll touch on a couple of those concepts here. I mean, the session today, we could speak for days on this topic, really, because there is so much backing the investment rationale for impact investing. So just briefly to contextualize where impact investing actually fits into the spectrum and fits into the scale. On the far right-hand side, we've got philanthropy. That's charity. That's not focused on generating a return. That's about doing good without the return. That's not where impact lies. On the far left-hand side, traditional investing. That is where there is no regard whatsoever. This is the good old-fashioned traditional investing. We are investing for a return, and that is that. There's absolutely no focus on ESG or any sort of impact whatsoever. Then we morphed further into the responsible investing. And when I say we, I'm talking more about the investment industry holistically, locally as well as globally, looking at integrating ESG, looking at mitigating risky ESG. It could include things like screening and so forth, potentially in some instances. That's again, where impact lies. Impact is then in between the responsible investing and the philanthropy. It's about addressing societal challenges. It's about having that social and environmental impact, while at the same time, again, generating a financial return for investors. Let's look at the concept of intentionality. So responsible investing, distinguishing essentially responsible investing, ESG, and impact investing. Now, the terms often get thrown around significantly. They get used in conjunction with each other. But ultimately, if we really just broadly aim to separate them to an extent, there's obviously always going to be a little bit of an overlap between them, because ultimately they have the they have the similar sort of goal at the end of the day. But responsible investing tends to get used as that umbrella term where everything gets bulked under. It's about mitigating risky ESG practices to protect value, or at the same time adopting progressive ESG practices, things like screening, shareholder activism. It can include exclusion. It can be about divestment. It can be allocation towards positive ESG outcomes. ESG, again, that's environmental, social, and governance. That's the investing in the systematic incorporation of ESG factors where these are material to performance. Very often this gets used in the public markets, not limited to, but a lot. So it has been in the past a lot more prominent in the public markets, although that has also changed significantly over time. And it can also include screening as well. By screening, again, we mean exclusion or inclusion in a particular sense. On the other side, we've got impact investing. Now, again, not completely distinct. They've all got the same goal at the end of the mind, but the concepts do differ. So impact investing, again, it's the focus on financial returns and the measurable social and environmental impact. Predominant, but not limited to private markets, and that's quite important here. So again, I mentioned to you the shrinking listed markets, private market investments, investment opportunities. And it's about contributing measurable solutions to global challenges. So your UN Sustainable Development Goals or SDGs. I'm not going to focus a lot more on those. I'm sure some of my other colleagues and speakers in these sessions will highlight those in a little bit more detail. But let me just make it a little bit more practical, perhaps with an example. So you'll see at the bottom, we've got a bank. If you think about investing in listed equity, in one of the top 4 or 5 or 6 banks, you're investing in a listed equity from an ESG concept. Now, banks tend to have a higher ESG ranking than some other listed entities. Why? They tend to be low carbon emitters. They're not the ones who are pumping volumes of carbon into the atmosphere. They are the ones who tend to have strong social practices, and they generally tend to have strong governance perspective. And so a bank gets ranked according to its ESG ranking. You're making an investment in a bank. The bank itself is not having an impact or necessarily having a strong ESG outcome per se, but it may have strong ESG criteria. On the impact side, however, you've got a renewable energy investment. So unlisted debt in this particular example. The impact investing is where you are actually investing in something, i.e. the renewable energy investment, that is having a direct impact. It is a measurable environmental impact, and it is giving you a financial return at the same time. So that's really the distinction between the two concepts. If I haven't given you enough reasons already as to why you would want to invest for impact, let me pick up on a couple of additional items that may convince you. Let's come from the position of a retirement fund. And whether you're a member, whether you're a retirement fund trustee, whether you're a service provider in this particular session, we are all ultimately people who at some point will be retiring. We have children, we have parents, we have family members. Think about what is it the world that you want yourself, your family, your children, your retirement fund members to be retiring into one day. I've spoken a little bit about South Africa, I've spoken about our current state of affairs. I don't think it's necessary for me to rehash that. We live here, we see the reality on a day-to-day perspective. But that is really, again, it's about the real economy. It's making that tangible impact in that real economy. Creating a healthy economy gives you sustainable returns. The two go hand in hand. And it's focusing our attention on those areas of the economy that really desperately need the capital for economic growth and for sustainable investor returns. Leaving a legacy for tomorrow. We can help tackle economic imbalances. That is really what is threatening to destabilize our country. And then members want this. So there's a lot of studies that have shown that members are a lot more conscious about where their money is being invested, and that they're actually looking for employers that are focused, or employees want to go and work for somebody who's a lot more focused, who has a fund which is a lot more focused on what's going on. Let's rest on the members for a couple of minutes and think about it from a retirement fund perspective. What is it that we want our members to walk away with at the end of the day? We want them to walk away with a healthy retirement. And again, think about the concept. What kind of a space are they going to be retiring into? And we need to think long-term from a retirement fund focus. Our focus is long-term. The focus isn't here on the here and now. It's far into the future. Why? Because if you think about active members in a pension fund, the younger members, these are individuals who are going to be receiving payments in 2085. And when I say that, it's irrelevant whether we're thinking about a defined benefit pension fund, or whether we're thinking about a defined contribution fund. The member is the one at the end of the day that needs that money and needs to be able to invest that money so that they continue to receive an income and are able to actually live in retirement. And even those members that are close to retirement, some of them are still going to be receiving a pension in 2050. The question is, how is our South Africa going to look like then? And is there going to be a South Africa that we can retire into? If we don't start now, what is it going to look like at that point in time? So how do we link up this partnership of impact investing and retirement fund investing? Let's look at some of the principles of retirement funds. So if you are a trustee, if you aren't a trustee, the same principles apply. We have trustees who have a fiduciary duty to protect the retirement funds of their members. That is ultimately their duty. Think about what I mentioned in the previous slide. Members have that long-term into retirement that they need to move forward into. The fundamentals of impact investing, it's a good match for your fiduciary mandate. Think sustainable, think long-term. And as I mentioned now, retirement assets, they are managed for the long run. We're not looking at the here and now. We're not looking at the 3-month performance, as pleasing as it may sometimes be, or as disappointing as it may sometimes be. We're looking at those members who are retiring, the 2050 cash flows, the 2060 cash flows, 2085 cash flows that those members are going to be needing at some point into the future. And again, regardless of whether it is a DB fund or a DC fund. On the other side of the coin, we've got the impact investing. Impact investing needs investors with a longer term focus. Even though you can see some of the gains in the shorter term, if there's a road constructed, you can see the road, you can see it working. If there's a clinic in a rural area, you can see the impact that is having. But it needs a longer term focus because these things are not built overnight. So impact investing, longer term focus, retirement funds have a longer term focus. Impact investing is focused on sustainability. What do retirement funds want? They want sustainable returns going into the long term. And impact investing is also focused on generating a positive return. It's all about doing good with a positive financial return. It's a beautiful aligned partnership and it absolutely works. If you need more convincing, think about mitigation of risk. There's global challenges, climate change, food security, water security. This is not a first world problem. This is even more a third world problem than it is a first world problem, and it is a global problem. The focus on sustainability, mitigation of risk, think cash flows, think long-term into the future. Where and how do we want to mitigate the risk? Investment return opportunities. Because your retirement fund is focused on the long-term risk-adjusted returns, there's almost like that demand and supply gap. And as that demand and supply gap is bridged, there are strong business cases to be made for investment. And then diversification, the good old adage, don't put all of your investment eggs into one basket. That absolutely applies here. So impact investing introduces diversification. That in turn has risk mitigating quantities in an investment portfolio, in a retirement portfolio. And so how do we go forward from here? Some of the factors for trustees to consider. Where is your fund potentially already exposed to impact investing? You can ask the question, how much exposure do you have? You might even be invested somewhere and you're not even aware of it. How does it translate into under the ground impact? Where are you actually investing? Can it be measured? What are some of the other impact investing opportunities available? Ask those questions. What is the impact on the fund? Think about your risk mitigation. Think about the diversification. Think about how your portfolio is constructed. And then which particular areas of focus, maybe from an impact point of view, is your fund invested in, if it is already? And these are all questions that your investment consultant and investment managers can support with. And then, of course, many of you are members as well as being trustees, and many of us are members of retirement funds. Ask the questions, drive the agenda, drive the debate. Have my retirement fund trustees considered impact investing? Where, if we are invested, where are we invested? What are the particular focus areas? And how does this ultimately benefit me as a retirement fund member, my family, my community, in terms of creating a sustainable South Africa right now and into the future. And so I'm going to leave you again with the pictures that speak 1,000 words. And the question is, which one do you choose? Thank you.
Well, thank you, Monica. I think it's good to know that as trustees, we have to drive the debate. We need to speak on behalf of our members to make sure that we do the right thing and that we stick and reach our fiduciary duties and the goals that we've set for ourselves. With that, I'm going to hand over to Jason Lightfoot from Futuregrowth. He'll be taking us through the impact investments and how it can be made real through infrastructure. Over to you, Jason.
Great. Thank you very much, Yvette. Good morning, everyone. My name is Jason Lightfoot. I'm a Senior Portfolio Manager at Futuregrowth Asset Management, managing our flagship infrastructure development bond fund. So I'm very honored to be speaking to you today about how impact investing can be made real through infrastructure investments and really unpacking the true benefits that such investments can have for both you, the investor, and also the community at large. I'm going to be focusing particularly on affordable housing and the real impact that can be derived from investing in this particular sector. So, I mean, obviously, impact investing is becoming an very important criteria for investors worldwide, thereby ensuring that when capital is deployed, that it can have both financial, social, and also environmental returns. The importance around the measurement of impact data can also be very critical. So therefore, it's very important that your asset manager is able to provide you with a sufficient level of comfort around the veracity of the impact of such investments that they make. Now, worldwide, we've seen this whole rollout of infrastructure. It's definitely the new buzzword across the world at the moment, with several nations investing in various infrastructure-led opportunities enabled to lift their economies. And we've seen the US as a prime example where they are looking at spending north of $1 trillion on various countrywide infrastructure plans. Of course, this will be funded through increases in taxes, but also the US, compared to other nations, has the ability to borrow at very low interest rates. Now, this brings us back to South Africa. So over the next 10 to 15 years, is it expected that there will be about an infrastructure funding gap shortfall of about 1.7 trillion rand across 276 different initiatives. Now, this is based on government's own infrastructure drive, and apart from the public-private partnerships such as the renewable energy program itself, which has been very successful, the owners of a large bulk of this would usually be expected to be funded by the government, as well as the various branches of government in the form of the SOEs. Now, South Africa's fiscal position is not accommodated to play a big role here. The government obviously issues bonds in the market, which it then uses the proceeds to fund its various expenditure programs. But the expectation is that the net debt to GDP number will obviously increase over time, further exacerbated by contingent liabilities. So what do we mean by contingent liabilities? So these are in the form of guarantees that are in essence provided to the likes of various state-owned enterprises such as Eskom. And the ultimate outcome of this being is that the government has the inability to fund various important infrastructure initiatives, as I alluded to earlier, given the current state of its fiscal position. I think the sovereign debt picture is primarily hampered by our inability to stimulate the economy and therefore grow GDP, and which directly impacts the ability to increase revenue through tax collection. Our inability to curb spending and improve overall fiscal consolidation is also very concerning for us as well. This again supports the need that the private sector needs to play an important role in terms of providing capital for our infrastructure rollout. Now, let's first set the scene and talk about what infrastructure really is. So in terms of a traditional infrastructure, the definition is defined as the basic physical structures and systems. So for example, things like buildings, roads, power supplies, which are constructed for the use of public enjoyment. Social infrastructure is slightly different. This pretty much includes the construction and maintenance of facilities that support social services. So this can include things such as healthcare, hospitals, medical facilities, ancillary infrastructure, education. So we're talking about things like schools, universities, student accommodation, and of course housing, And then other sort of facilities that support civil functions. So, for example, things like courts and prisons. So given the ongoing constraints that I alluded to earlier, and given the constraints from a governmental finance perspective, there's definitely a greater need to seek alternative funding solutions across the board in this regard. So as I mentioned earlier, our key area of focus in terms of this presentation is going to be on the affordable housing sector. Although government does address the need for housing, this is primarily in the form of social housing, in terms of grants, particularly which is addressed via human settlements. There's definitely a gap in other areas which the market can also play a defining role, and particularly in terms of affordable housing. So if you include this as part of the greater infrastructure strategy and gap, it takes the funding gap to north of about 2 trillion rand over that 10 to 15 year period. So definitely a place where both the banking sector and the retirement fund industry can play a role. Can be done so within the affordable housing space. So this is typically referred to as the gap market, and it's estimated that there's typically around a shortfall of about 700,000 units which need to be funded and built over a defined period of time. So this bracket pretty much includes those people that earn between 3,500 rand and 15,000 rand per month, which is pretty much too little to enable them to apply for traditional mortgage-backed financing, but yet too little for them to qualify for a full government subsidy. So the advent of COVID and the impact of shrinking incomes has also placed a greater need for cheaper housing options to households having no option but to scale down in that regard. So what are the real challenges from a housing perspective? I mean, we know that the Bill of Rights and the Constitution both enshrine the rights of South Africans to adequate housing, which obviously puts an obligation on the government to take all reasonable steps to achieve this. So in 2019, there was an estimation of about 17.2 million households in South Africa, with about 12.7% of those actually living in informal settlements. So that accounts for about 2 million households living in informal arrangements. This is obviously much worse on a municipal level, where in both Joburg and Cape Town, the number stands much closer to about 20% of the total households in those particular areas. Sure, the government is playing a role, and as I mentioned, primarily in that housing settlement sector, in the form of RDP housing, grant initiatives. But obviously, given the overall fiscal constraints that I alluded to earlier, it's really not enough funding available to solve the holistic problem. And there's definitely a role and a defining role that the capital markets can play in this role. So the view from our perspective is that the banking sector, as well as retirement funds, can definitely play a role within funding that shortage, which is currently evident in that gap market, to solve the ultimate 700,000 unit shortfall that we're currently seeing. There's a whole number of different possible solutions to address the problem, some of which we've seen come into action over the last few years, but a lot more can definitely be done in the space. We've all seen the success of the inner city rejuvenation of the Joburg CBD itself, and this is obviously rolling out to other CBDs across the country, and definitely through the great work that the likes of the Trust for Urban Housing Finance are currently doing, and others as well, through the facilities that they then provide and continue to provide to various entrepreneurs in the space, who then obviously buy rundown apartments, rundown old buildings, and rejuvenate those to create affordable housing solutions, both for sale and also for rental as well. We've also seen the success that various developers have also had across the country in terms of achieving really cost-effective developments, thus achieving various affordable housing solutions. So this is also evident through the likes of the great work that companies like Cosmopolitan Housing and Baldwin Properties has also done in terms of the various boarding solutions that they've created over the years. More recently, we've seen some great innovative solutions also coming to the market, where various developers are actually converting old unused office blocks to create affordable housing rental accommodation units at great rental prices for the market. So government can also play a role here, primarily in terms of, sure, they can't play a role in terms of providing funding, but they can create an enabling environment, particularly when it comes to aspects such as zoning, potentially tax incentives, and also ultimately ensuring that the municipal infrastructure is there to support these underlying initiatives. You don't want to build a new block of apartments or housing developments if the municipal infrastructure can't handle the bulk that's required to service those underlying units. Funders ourselves can also play a role here by taking a longer term view of the sector, but still ensuring that the capital that we provide is properly risk adjusted in that regard. So from a lender perspective, it's very important to partner with the right players in the space. I think from a future perspective, we ensure that we look for partners with the following characteristics. In essence, before approaching a potential opportunity, you want a strong management team with a sound track record. On a weekly basis, we are approached by a whole range of developers looking for funding in the space, with many of them wanting to jump onto the momentum, but without the requisite experience. Now, you might also have a great management team who are able to roll out new developments, who are greatly skilled in those sort of competencies, but do they actually have the required property management skills? And this is really critical if they decide to go down or embark on a rental strategy. And this is of utmost importance to lenders to be able to assess the ability of those players to do so, and also so if they decide to outsource that ability to a third party. The provision of capital really is a two-way street. Now, things don't always go to plan. There might be overruns. The budgets might not be 100%. So it's important that the lead underlying shareholders have both enough skin in the game and also deep pockets to ensure that there isn't an imbalance in respect to the lender's role in terms of having to pony up for additional funding. As with any lending arrangement, lenders' protections are also only as good as those captured in underlying legal agreements. So therefore, the ability to build the right levels of protections in legal agreements remains a key priority for ourselves as lenders. Also, an important inclusion would be around ESG considerations. Many of these entities are unlisted in nature and don't necessarily have the right frameworks around ESG at the onset. So it's therefore important for lenders to be able to work together with the borrowers to ensure that these requirements are taken into consideration over an agreed period of time. So in terms of when making these investments, it's important to consider the direct impact that these have overall. So from an affordable housing perspective, the impact outcomes include various aspects such as reducing the overall housing backlog. I mentioned the 700,000 backlog from an affordable housing perspective, therefore increasing the ability to create affordable housing units, which are ultimately close to transport hubs, which ultimately has the benefit of improving the quality of life for these underlying individuals. And let's not forget the ultimate benefit from a job creation perspective, both in terms of the build and the renovation of those new units and the ongoing maintenance that's associated with such housing opportunities. So just in terms of future growth, through our various developmental funds, we've invested about 2.3 billion rand in the space, which has resulted in some great statistics coming out from that, from an impact perspective, financing just close to about 3,000 different projects, which has resulted in about 49,000 affordable rental units, with an average rental of about 3,500 rand per month. This also has assisted in the creation of about just over 9,400 temporary opportunities from a job creation perspective, and creating 800 different permanent employment opportunities in that regard. Now, what role can yourselves as a retirement fund industry play in this space? Now, obviously, it's important to look at Regulation 28. Does Regulation 28 actually allow investments in affordable housing? So let's first start off by asking, what is the sole purpose of Regulation 28? Its main aim is set out there to protect savings by allowing for diversity, and also thereby stipulating limits in terms of how much can be allocated to a specific asset class. So currently, given that many of these opportunities are mostly unlisted in nature, they'll obviously fit within that sort of criteria. They fit primarily in respect to the total unlisted allowance that's currently afforded under Regulation 28, which is a total allowance of 35%. So this encapsulates both debt opportunities as well as equity, primarily in the form of hedge funds and potentially private equity funds as well. Now, At the beginning of this year, we were all aware of National Treasury's stance in terms of creating various amendments to Regulation 28. And the sole purpose of those amendments was to make it easier for pension funds to invest into infrastructure. So I think that the asset management industry as a whole is usually supportive of this aim and believes it's important to highlight the real active role that the retirement fund industry can play in terms of assisting economic growth through infrastructure investments. One of the proposed changes in terms of what National Treasury came forward with was around the definition of infrastructure, which in our view was a very narrow definition and pretty much excludes all non-governmental infrastructure initiatives, and which would therefore mean that no private infrastructure initiatives would therefore be recognized as infrastructure under this definition, which therefore would preclude funds from investing in such initiatives, but it wouldn't really necessarily be recognized as such. So I think the retirement fund industry as a whole, through various specialist managers, has over the last 2 decades invested in a whole range of private sector opportunities, like housing infrastructure, for example, which has ensured, both tangible returns for both pension funds as well as the country at large. I think the market as a whole is largely in agreement with the definition, that the definition should include both public and private infrastructure in that regard. And ultimately, funds need to have choice in that regard. We therefore believe have choice in terms of how they deploy their capital, and therefore believe that investments in affordable housing should therefore also count as infrastructure in that regard. I earlier alluded to how infrastructure funding shortfall, will pan out in the next 2 decades, and pension funds can ultimately play a very meaningful role here, particularly those that haven't made investments into the sector to date. There have been some pension funds that are currently bumping into limits, and well done for themselves. But ultimately, this needs to be done in a very sort of put retirement funds at risk by making suboptimal investments. I think the main sort of theme is that investment fundamentals need to prevail at all times. It's great making an investment that has great social outcomes, but ultimately you need to be compensated for the risk that you are taking. So all we believe that deployed capital and need to ensure that such capital opportunities are ultimately sustainable. I think the key theme around this is around bankability. Bankability is really the key word here, meaning that such projects need to have identifiable cash flows that are therefore able to service interest and capital in respect of the debt facilities that are afforded to them, as well as adequately provide sound returns to those equity providers in the form of the private equity funds. So I think the view being is that this can be done through partnering with the right players and also through the right opportunities in this space. So for example, funding a affordable housing opportunity, but it's not close to a transport hub. It doesn't really make sense because it doesn't have the desired benefit in that regard. Government also has to play a role in terms of creating a very enabling environment. I spoke earlier about ensuring that the infrastructure works, potentially looking at aspects like tax breaks, tax incentives, those sorts of things. And then from a borrower perspective, there's also a change of mindset that needs to occur as well. So by tapping into institutional funding, there are definitely different sets of rules and requirements that apply, particularly around ESG, and also the real need to provide investors with detailed reporting around the impact of such investments that we can therefore report back to our ultimate investors in the funds. So in closing, the retirement fund industry can definitely play an important role here. We have the capital and the will to invest, but also ultimately we need a pipeline of bankable, investable infrastructure opportunities that have substantial on-the-ground impact for the creation of a better South Africa for all. Thank you.
Thank you, Jason. I think it's quite scary when we look at the statistics and see what the shortage of housing, for example, is. But it's good to know that the regulations do allow us to invest and assist possible future members to obtain housing should we consider investing in affordable options. It's also important to note that we have to choose carefully who we partner with and what other aspects we need to look out for when considering these types of investments. Once again, thank you, Jason. And just a reminder to all, if you have any questions, please log them on the chat function during the Q&A. We will go through each of them. On that note, I'm handing over to Nazmira Mula from 91 to take us through the just transition, mitigating and adapting to the new climates.
Thank you very much, Yvette. Thank you for everyone for joining us this morning, and for the previous speakers who I think have laid out the framework of impact investing and how we think about it. Jason's talked about this in respect of affordable housing. I'm going to spend some time talking about energy in South Africa. So if you remember, one of Jason's slides talked about the impact infrastructure funding gap in the country being just over 2 trillion rands. And within that, energy was 60% off that at 1.2 trillion rands. And I think sometimes energy feels a little bit far away, it feels a little bit commercial. But if we look at why South Africa's growth rate has been as stunted as it has been over the last decade, there are many reasons. Corruption, poor regulation in many areas, but the electricity constraint is probably 25% to 1/3. So 1/4 to 1/3 of the problem with South Africa's ability to grow at this point in time is the electricity constraints. Therefore, beginning to resolve that constraint is really important. And added onto that, what we're now seeing is this massive movement globally away from carbon because of global warming. And we're seeing the manifestation of global warming with the droughts that we routinely see around our country, Eastern Cape right now facing some very dire water shortages, but we also see the same in California where there are wildfires, floods in Germany and China at this point. So two angles why we think focusing on the energy sector is really important at this point. One, South Africa's growth outlook, and second is this push that we're seeing around climate change. So let me share my screen. There we go. And what you see, so as we move forward, South Africa's electricity grid at the moment is the most carbon intensive in the world. I know that sounds pretty startling. It was when I first looked at this graph and realized that the carbon content of electricity generation in South Africa is exceptionally high. And the reason for that is 86% of our electricity comes from coal-fired power stations. And whereas a decade ago, other countries like India were at the same level, what's happened in that decade is they have massively accelerated their renewable energy programs. We're seeing the same even in China, where they're still building new coal, but they're building renewables faster than coal. And as a result, the carbon intensity of South Africa's exports is double that of China and 75% more than India. And I think that that's something to bear in mind as we talk through this, is we have a very carbon intensive grid in a world where carbon is becoming the main evil for a lot of people. We're seeing this massive run up in to COP26 in November, and there's this focus around it. And the reason I think it's important to bear this in mind is what the risk we face as a country is this starts to affect our ability to attract investment, both into our bond markets, but also foreign direct investment going forward, and therefore our ability to create jobs. And that's the reason I think we really need to take this quite seriously. So if we look back at the Integrated Resource Plan, which was published in 2019, the trajectory in that plan will keep South Africa's electricity production amongst the most carbon intensive in the world for decades to come. What we saw come out 2 weeks ago from the Presidential Climate Change Commission is a much more ambitious decarbonization plan. And I think that the question is, can we get the country as a whole to buy into that? What we're seeing globally at this point in time is global private and public capital from many parts of the world will just not finance high emitters. So 140 global banks, insurers, and investors have said they will not be financing any more coal mining or coal-fired power plants. The hurdle for South Africa's banks to finance new coal projects, as one of them said to us, is very, very high. Effectively, some of the banks, like Nedbank, have said no more, but some have effectively saying we're not going to write it down, but effectively we're not going to be producing, we're not going to be financing any more coal power or coal projects, new coal projects at this point in time. So what else we've seen globally at this point is General Electric, which has long supplied the components for power stations, saying that they won't be supplying equipment to coal-fired power plants going forward, and a recent report from the International Energy Agency. Now, let's just remember the International Energy Agency came out of the oil industry in the 70s and 80s. It was, that's its genesis. And now it produced a report a month ago saying there should be no more fossil fuel projects.
Oh my goodness, it seems that we've lost Nazmira. We'll give her a few moments to join us while we wait for her to come back. I'm quickly going to revert to some of the questions that's been coming through on the chat. The first question raised by Terry is for you, Monica. Can you please give some sound examples of impact investments in South Africa and their respective investment returns?
Thanks, Yvette. Thank you so much for the question. And Terry, thank you very much for the question. Much appreciated. So absolutely, we can give some examples. I mean, I think we can certainly provide some more and share some more after the presentation. Maybe just to run through a couple of them. I've got a couple of examples in front of me. This is data until the end of June. There's a certain renewable energy fund, unlisted. It's an unlisted investment up to the end of June. It's given 10.4%. Its benchmark is a cash plus benchmark. It's cash plus 50 basis points. The cash plus benchmark has returned 6.6%. So that's 36 months annualized, so 10.4% annualized. Another example is, and these are investments that are some of the client portfolios that we run, hence got the numbers at the touch of my fingertips. An infrastructure bond fund. There's an asset manager that runs an infrastructure bond fund. It's invested in both listed and unlisted investments. It's returned 10.3% over the 36-month period versus the All-B and All Bond index, which has returned 9.3%. Over a 5-year period, it's returned 9.6%. 10.6% on an annualized basis as well. Another example is a development property fund. So this is an unlisted property fund that focuses very much on rural property developments. And again, a return over 36 months of 10.2%. It has a benchmark of inflation plus 4%, and that has returned 8.7%. So all of these over that particular period, over that 36-month period. This particular development property fund also has a return of 9.3% over 5 years. That's on an annualized basis versus its target or its benchmark of CPI plus 4%, which returns 7.8%. So quite a strong outperformance. If I can maybe put that into perspective for you, relative to something like cash, just plain old ordinary cash, represented by a STEFI type of benchmark, the return for that over 36 months has been 6.1%, and over 60 months, the 5-year period, 6.6%. So just a couple of live examples that we have. As I said, this is data until the end of June. I do hope that supports with the question, and I'm very happy to share some further examples with you, perhaps at a later stage or offline. Very happy to take your further questions. Thanks, Yvette, and thank you, Terry, for the question.
Well, thank you. I mean, over a 3-year period, those returns sounds quite amazing. There's lots of thanks for the very insightful presentation. Thank you, Monica. I tend to agree with Lynn. You are an inspiration to the rest of us. It's definitely something we should be considering going forward. I see Naz is still trying to get back on to join us. If there's any questions, please remember to load them on the chat box, and we will then raise it with the various presenters. At this point in time, just another quick question for Jason. In terms of the backlog, do you think we will ever reach a point where there is no backlog in housing in South Africa?
Yeah, I mean, in terms of that affordable housing space that I spoke about, I mean, the backlog is massive, but again, developers are kind of getting up to speed in terms of, you know, rolling out opportunities. But again, it comes down to the funding. You know, we need the funding to match up with the opportunities that are out there. But again, at the same time, we need to ensure that the infrastructure kind of meets the requirements in terms of supporting those initiatives. So I think, you know, over time we will definitely see some reduction in that backlog. But overall, you know, government also needs to play a role in terms of that social housing space to ensure that the needs of the lower LSM levels are also met as well.
When you look at the needs in South Africa, they're quite great. Nazmira, are you back on this call yet? Not yet. Okay. Monica, Jason, any further comments that you would like to make?
Thanks, Yvette. You know, I think maybe just off the cuff, something to think about is, you know, there's a lot of information for trustees, and I think that's something that we recognize. There's a lot to take in. There's a lot of maybe terminology that gets thrown around and gets used, and I think sessions like this certainly are very helpful and insightful to start unpacking some of these things with trustees. I guess, you know, I would just urge trustees to continue the debate, to continue the discussion, and to really ask the powerful questions of their service providers, of their asset managers. You know, what is it that we're doing? How is our fund looking? What is it that our appointed asset managers are doing to take these things into consideration, whether it's on the impact side or on the ESG side? The more questions and the more really power that comes, that sits with the asset owners, the more the debate will open up, and the more the opportunities will open up, and the more clarity there will also be for trustees with regard to these investments. You know, there was talk just now about the risk, and Jason mentioned, you know, we do need to be cognizant of these things and take the risks into account. And the more we engage on these topics, the more I think the more opportunities and are available then for trustees, and transparency also being key. Thanks for the opportunity, Yvette.
Thanks, Monica. Nazmira, over to you. Welcome back.
Thanks, Yvette. Our technological challenges are, you know, you think that 18 months into COVID, we all run smoothly, but not quite as smooth as you hope.
And then just go there, yeah. The three dots there, and then settings. Okay, so what you're gonna do is just type in camera.
I think someone's microphone's still on. If they can put it on mute.
Yeah. And then just go to side settings, and then just go down. So
can we mute his microphone?
You select that. Yeah.
Okay.
And then you just say polycallisto.
We do seem to have a few technological moments. Let's carry on. Okay, so what I was saying before I was cut off was what we're seeing is this massive shift from capital saying they will not be financing new coal-fired power stations, new coal mines, and increasingly gas is becoming part of that list. It's not quite there. It's still regarded as a transition fuel, but it is part of that list. On the other side, so that's what we're seeing from banks and the suppliers. What we're seeing from the asset managers is this net zero asset managers initiative, which is basically supporting the goal of net zero greenhouse gas emissions by 2050 or sooner. Currently, there are 128 signatories to that with $43 trillion in assets under management. And I think when Monica was talking at the beginning around impact being primarily a private markets initiative, well, not initiative, but the execution in fund management has been centered around private markets. What we're starting to see is some growing focus in public markets. And one of the areas is in emerging market debt funds. And why this is really important for us is foreign investors are big funders to the South African bond market. And if what we're starting to see is a growing focus on sustainability in those funds, South Africa's poor scores on a range of things from education and healthcare, but also to carbon emissions, means that we tend to be excluded from those funds. And that will begin to affect our borrowing costs at some point in time if you have a growing pool of these assets. So the other big risk for us is the EU has been talking about a carbon border tax. So effectively, they're trying to reduce emissions from their own producers within the EU. But what we have is a number of companies operating there saying, well, they need to be able to compete on a level playing field with goods being brought in from the rest of the world. And therefore, the solution that's been proposed, which there's much criticism of at the moment, is that taxes will be levied on goods coming in from high carbon intensive areas. Understandably, the likes of India, China, even the US are fighting this, but that is what the EU is proposing at this point in time. And we know that the EU is South Africa's largest trading partner. So if we start to see actions like that going ahead, the impact on companies locating manufacturing in South Africa will start to be felt. Think about our auto industry. A number of German and Japanese manufacturers locate in South Africa, but if suddenly them exporting their production back into Europe will face a border tax, that production is likely to be shifted elsewhere. So where I'm getting to is we need to start to deal with the carbon intensity of our grid. Because if we start to have a plan to reduce the intensity, it's then very possible to make the argument back to developed countries that, well, you can't measure our current level of emissions, let's measure our plan. Because measuring our current level isn't fair. You had hundreds of years to emit into the atmosphere. Most of the stock in the atmosphere is yours, and we have emitted far less in history, but we have a plan to reduce our emissions. And unfortunately, right now, South Africa doesn't have enough of a plan. But as I said earlier, that PCC report that came out a few weeks ago does look really promising. So how does this feed into something that you can invest in as a trustee? And I think one of the things to think about, which I think has had quite profound impact on this whole discussion around carbon, is the plunge in renewable energy prices over the last 10 to 15 years. So the graph on the left-hand side in front of you, PV is photovoltaic, so solar, and then wind is the blue. So the yellow bars are solar prices, blue bars are wind, and what we've seen is solar costs have fallen by almost 90% in the last decade. Wind has fallen by 70%. So when you hear people talking about expensive renewable energy, maybe 12 years ago it was, but right now it's far cheaper than coal, because that's what's happened in the intervening period, is the prices of this new technology, much like the prices of computers or home electronics, have fallen dramatically as the technology's advanced. The one area we're still watching is batteries, where you can see the pink line also fallen quite dramatically, but it's still not at the price point where you could run a grid solely on renewables, because battery prices need to fall by at least half their current rate in order to start making that viable. But if we look at the shape of that pink line, it's looking like it's very possible in the next 3 to 4 years. So plunging renewable costs have left wind and solar far cheaper in 2020. This is not a future projection. The little table on the right-hand side shows wind levelized cost cents per kilowatt hour, 71 cents per kilowatt hour in South Africa, solar at 62, coal at 118 cents. And we project forward to 2030, and we expect the price of wind and solar to fall even further. The charts on the left-hand side, there are lots of pretty maps with lots of colors. I think what we try to show is the solar, the top chart on the left-hand side. The darker it is, the better it is for your ability to generate electricity from the sun. And South Africa is pretty dark. Wind, the average wind speed, the middle one, the more green or blue it is, the better your wind speed, the better your ability to use wind. And South Africa is reasonable on that score. But then if you look at the bottom one, the places where you have this combination of wind and solar on a reliability basis, ideally for this basis, you'd want to be red, but then you wouldn't want to live there. It would be too hot and windy. However, something in the yellow and the pale green is desirable, and that's exactly where South Africa fits. South Africa, Australia have some of the best wind and solar resources in the world, far more attractive than Europe, and therefore we have a great ability to take advantage of this. It's the reason why the German Development Bank is partnering with Sasol to develop green hydrogen. Much cheaper to do it in South Africa than to do it in Germany at this point in time, given our wind and solar resources. And that's something that the transition offers us an ability to think about, thinking about wind and solar as a resource. What are we seeing globally? So these are the projections over the course of the next 30 years, is massive increase in renewable energy production and this continued tailing off in coal and gas power. We've already started to see a big pickup over the last decade, but this is expected to accelerate massively over the course of the next 30 years. And most interestingly, the tables on the right-hand side here just show you the projections in 2019 versus 2020. And what we see is that the forecasts for 2050 continually get revised up for solar and wind and down for coal. And we would expect that to continue. So I've spent some time talking about the global environment, why capital will increasingly not fund coal projects, coal power stations. Countries that have high levels of coal emissions will struggle to get funding. But let's think about it the other side. What's the opportunity this presents? So I've said we have a great solar and wind resource, but also when we look at the ability of this transition to renewables to create jobs, to support industries, it's actually quite immense. So there's been quite a lot of detailed modeling by Oxford University on this, and they show that the shift to renewables results in about 800 billion rands of investment by 2040 and about 1 million additional jobs relative to IRP 2019. So this is the macro view. I'll get down to the micro in a little bit because it's all good and well to talk about the overall economy benefiting. And at the beginning, I said one of the biggest constraints to South Africa's growth over the course of the last decade has been its electricity shortage. Alleviating that shortage will open up massive opportunities for investment. We look at our mining sector right now, which has been so important in boosting our tax revenues in the last year. They're talking about expanding exploration, expanding production, but in order to do that, they need reliable electricity, and they're prepared to self-fund that electricity. So the fact that we finally saw the publishing of the self-generation regulations on Friday, apparently quite badly worded regulations, but at least we now have a increase in the limit from 1 megawatt to 100 megawatts, which will allow the mining companies to start to alleviate the electricity constraints and therefore look at expanding their production in South Africa, expanding jobs in the country. So what is the internet? What is the backdrop here? So the Paris Accord in 2016, the COP in 2016, developed markets promised to provide $100 billion of funding to emerging markets, to $100 billion per year to emerging markets by 2020 to support the transition. There's been very little evidence of that materializing. There's been very little evidence of these flows. There are small pockets of it. Simon Howie, who will speak later on, also from 91, will discuss some of the mechanisms we've tried to develop to facilitate this, but effectively we've seen very little develop. So what we are starting to see a lot more discussion on how this is accelerated. The other area to think about what South Africa can offer in this is, how much is it going to cost us? So I've spent a lot of time talking about the threats from climate change, from the shift in global capital flows, but the other part of it is, can we afford this? Because what we heard Jason say is the budget is under severe fiscal constraints at this point in time, and therefore this massive transition, is it really affordable? Shouldn't we just live with our coal for a lot longer? And I think what is important is that often when the cost of renewable projects are compared to the cost of coal, we don't take into account the maintenance costs of coal, and we see the impact of poor maintenance on the reliability of Eskom's fleet on a weekly basis right now. So once you include maintenance costs of old coal-fired power stations, what we find is the least cost option for South Africa in many cases is new renewables. And on that basis, what South Africa is able to do is offer around 1 to 1.5 gigatons of carbon reduction relative to IRP 2019. So there's a lot of words I've just chucked in there. I think the way to think about it is if you're going to turn around and say, well, South Africa is able to offer a massive carbon saving, you need to measure it against something. We're measuring it against the Integrated Resource Plan in 2019. And what we're saying is, relative to that, you could actually shut down coal-fired power stations faster at relatively low cost because there's such large maintenance bills that are going to come due for those stations, and in the process save 1 to 1.5 gigatons of carbon. And that is something that we need to try and monetize as a country, and mechanisms need to be worked out to figure that out. Because if we think about a just transition, there are 4 elements that need to be funded. We need to fund the new renewable energy generation capacity. We need to fund the new transmission infrastructure. And both of those are areas where the average pension fund can certainly play a role in providing the funding, can take advantage of the returns that come from that. There have been very good returns made in the space, and there's clear impact that can be measured. The other is to support workers and communities. And the fourth is to encourage the early retirement of old coal-fired generation. And the bottom 2 is where it becomes more tricky, and we need a larger element of grant funding in those components. We start thinking about what a just transition would look like. The key, the nexus for South Africa has to be in Mpumalanga. TIPS, which spun out of the Department of Trade and Industry many years ago, is doing a lot of work around what a just transition in Mpumalanga looks like, and this will include worker support mechanisms, reskilling, compensation, but it will also include the infrastructure, this upgrading of the energy system that is needed. But it's this combination of making sure workers are supported as well as building the new infrastructure that gives you this just transition. So in summary, I think this is worth dividing up into threats and opportunities. The threats that South Africa is facing at this point in time is limited access to finance for new coal, but also a threat to our ability to attract foreign investment, either through the bond market over the next 10 years, but in direct investment on a shorter time period if we do not start to dramatically reduce the carbon intensity of our grid. And the other issue is the unsustainability of Eskom's debt. We already know that every year there's a large transfer from the fiscus to Eskom, and there's no clarity on how this is resolved. The opportunities that we have, so I've sketched the threats. The opportunities, though, are more numerous. So massive decline in renewable energy costs over the last decade, the fact that South Africa has this leading solar and wind resource, the ability of a transition to create jobs, and then the surge in global and local funds available to fund the carbon transition. So globally, this is much more apparent, but even locally, we're starting to see more of a focus in terms of taking advantage of the infrastructure build, but also taking advantage of the renewable build in particular. And then the last is, how do you make use of this commitment from developed markets? How do you make sure they deliver as well? Because it's very easy to promise and not deliver. And I think in order to ensure delivery here, what we need to see is emerging markets making tangible commitments. And that's why I went through all those technicalities of trying to explain how much carbon South Africa could actually save. But if emerging markets like a South Africa or an Indonesia or an India can make a tangible commitment on the one side, we then need to figure out how that is funded and supported on the other side. And I think let me leave it there and hand back to Yvette.
Thank you, Nazmeera. For me, it was quite interesting to see how the prices of green energy has come down over time. There's a question for you from Radesh. Playing devil's advocate on coal and renewable energy. What we're now experiencing as a result of 125 years of industrialization, mainly in the north, should it not be that the polluter pays principle, which applies here, i.e., we in South Africa cannot fund the transition ourselves? Should it be funded by industrialized countries? This would release scarce financial resources for other impact investments.
So, Radesh, I am largely in agreement with you. And that's why I went back to this commitment that's been made of $100 billion a year that was promised that has never really been delivered. So I do think there needs to be some inter-regional funding here, because what we've seen successfully is in jurisdictions that have accelerated their retirement of carbon, we've seen fiscal transfers to support it. So, for example, Germany right now is having a reverse auction where private sector owners of coal plants or even old gas plants can effectively sell their capacity to the fiscus and not produce for an annual fee. And that's fine if you have the capacity to do that because you're borrowing at really cheap interest rates as the German government is or the American government is. South Africa doesn't have that luxury. And therefore, we need to think about inter-regional transfers to fund this. So I think I agree with your point. I would say that we need to be clear on what we're offering, though. And there isn't that clarity as yet, which is if we're going to commit to this, what are we committing? What are we prepared to do in order to receive support on the other side?
Thank you. Terry says, thank you for a thought-provoking presentation. We all need to act now for future generations. At Terry, there's a couple of investment returns that's been loaded onto the chat just for your records if you want to have a look there. Lynn says it's scary facts. It makes us essentially important for us to seriously review our investment strategies going forward. On that note, I think we can take our 7-minute break. I will see all of you back here at exactly 4 minutes past 10, where we will then continue with our insightful presentations. We will start with Glenn Silverman, how to invest for impact. So we will look at the more practical investment side. Have a great break, everyone. See you in 7 minutes. Welcome back, everyone. I hope you've taken the chance to stretch your legs, fill up your teacups, and that you're ready for the next section of our infrastructure and impact investment sessions. At this time, I'm going to hand over to Glenn Silverman, the Director of RisCura Investments, to take us through how to invest for impact, touching on how RisCura's funds action this. Over to you, Glenn.
Great, thank you very much. It's great to be here, and thank you very much for the opportunity. I do appreciate it. As was mentioned a little bit earlier, I have just recently joined RisCura as the investment strategist. So this is my first presentation on their behalf, and I've asked one of my colleagues just to run through the slides for me, because scared of technical hassles, which I've seen Mira and others sometimes suffer from. So I would like to avoid that pain. So let's go into the next slide. Just in terms of what I'm hoping to cover today, I'm going to start with the introduction, 3 parts to it, a single slide on the opportunity, have a look at the challenges, and then some of the potential solutions, give a bit of a sense of RisCura's approach to impact investing. There are so many issues to deal with, so I'm only going to delve into a few a bit deeper, have a look at the Fund of Funds series that we've just recently launched, and then conclude. Next slide. So the opportunity, there's a clear need and a desire to invest in this space. We've had a wonderful introduction by 3 speakers a bit earlier, talking, and I guess more theoretically about kind of the need to do what we need to do. This follows very strongly from Monica's presentation, for example, but there is a clear need and a desire to do this stuff, and I'm going to try to deal with some of the more practical aspects. There's a realization that the savings outcome are as important, because as much about the environment in which you will use those savings as the amount of savings themselves, and also the fact there's a real need to invest in the real economy in South Africa, in other words, to make a real tangible difference. This demand is supported further by the likes of the concept of doing well while doing good. So many people have a value system that would align with this particular aspect. As Monica mentioned, there's been a very strong increase in the focus on sustainability investing, also called responsible investing, and the acronym ESG comes to the fore as well, with other potential benefits, both financial and non-financial. And so I think the opportunity is clear to everyone. Next slide, Howard. However, there are many, many challenges. This space is just not a simple space, and there are many challenges. I've highlighted a few. Firstly, a lot of this is dealing with investing in unlisteds, and those come with their own complexities. How do you price them? They're illiquid. The terms and conditions relating to the various aspects become very, very complicated. How do you implement an appropriate governance frameworks? How do you achieve competitive returns? Can you have your cake and eat it? Can you do social good and at the same time also get competitive returns? How do you ensure you have meaningful impact? How do you score that? How do you deal with all of those related aspects? And there are many different impact kind of concepts underlying. Then the need to optimize at various levels, whether that's if you take a fund of funds approach, manager selection, portfolio construction, risk monitoring, et cetera, and then ongoing risk management. And so I think for some of these reasons, this space has taken a long time to get going. There are very few funds available that deal with this particular area because of the challenges that we are faced. Next slide. And so in order to come up with the solutions, I think it's really important that one does focus on those challenges and say, how then do you solve for each of those? And I think broadly there's 2 approaches. You know, the single managers would say, we have a fund in a certain dedicated space, be that housing, be that infrastructure, be that education, whatever the case might be. And I guess the advantage of that is you know exactly what you're getting. But with that, obviously, you have single manager risks, single thematic risks, etc. And so another approach might be to consider a fund of funds type of approach instead. And then there's so many aspects that need to be covered. You know, I mentioned the complexity of those investment structures and unlisted, etc. I'm going to touch on a few of those in a little bit more detail a little bit later. But I think the fact that one considers a fund of fund approach helps to deal with and mitigate some of those risks, and obviously to obtain much wider diversification. Next slide. So how do we approach impact investing? So we've really decided to go on the following basis, and that's really to ensure an alignment with both global and local development frameworks. I think everyone should be well aware in South Africa of the National Development Plan 2030. It sets out a plan for South Africa in terms of where we want to go into the future. At the same time, the United Nations have issued their Sustainable Development Goals, also 2030, and there's 17 of those. And so we wanted to come up with something that aligned with both of those, but also use the framework of CRISA, the Code for Responsible Investing in South Africa, to provide a framework and a lens for assessing all of that. And so trying to look at global best practice along with local best practice too. And so it's a very colorful picture here. What we try to show in here is the matching of those portion of those 17 SDGs, the United Nations ones, some of the targets that they have, the National Development Goals, some of the objectives underlying each of those, to come up with a subset of what we think South Africa can deliver. This is an enormous exercise done, and we have a whole reporting framework around that. I don't want to spend too much time on this, although one could obviously go into a lot more detail. So if we go to the next slide, we essentially distill that down to these 8 areas that we think are the most important, that align with both of the SDGs and the National Development Plan. And these are our targeted impact themes: education, healthcare, jobs, inclusive finance, infrastructure, clean energy, affordable housing, and sustainable healthcare. I think most would recognize that they probably are at the heart of the most important aspects that we need to deal with in our country. So let's delve a little bit deep into some of those areas that I said bring a certain complexity, and why I believe that there's not much product out there. The practical aspect of launching the stuff. Theoretically, we all want to launch something in the space, but practically investing in the space is actually fairly difficult. So some of the aspects that I've chosen, and some of the aspects that require some form of optimization, is manager or fund selection. How do you choose the correct manager? That requires a fair level of investment due diligence, but in addition, and in particular in the space, an operational level of due diligence much higher, I would argue, even in the investment aspects. And so choosing the correct fund and underlying structure has a huge level of complexity, and the implications are quite significant. How do you score impact before you invest with the manager, while you're investing with the manager, and after you've invested with the manager? And I want to chat to that aspect in a little bit more detail a bit later. Putting this portfolio together has portfolio construction and risk management challenges as well. And as I say, in this particular space, the T&Cs, the terms and conditions, are very, very detailed, very long, very complicated, very many. And so those have to be looked at very, very carefully. And then ongoing, how do you manage cash flows? How do you value the assets? How do you monitor the different aspects ongoing? And remembering that we're doing something which is very unusual. In the past, we always spoke about risk and return as this 2D type of world, but we now have a 3D world, 3 dimensions. It's risk, return, and impact. We might give up a bit of return to get a bit of more positive impact. We may have to take on a bit more risk to do the same. And so that becomes a very interesting equation to solve. And then obviously the ongoing monitoring and governance aspects are critical as well. However, each of those require dedicated expertise and focus. I would argue very strongly that this cannot be done part-time. This is something that really needs a depth of resource, years of experience, people who are focused on each of those different areas so that you can come up with an optimal solution. So, thank you. So the way and I want to talk and delve a little bit more detail into the impact aspects, because I guess at the end of the day, that's the discussion for today, is how do you come up with a framework to score managers, projects, etc. And we decided to go with the impact management projects scorecard. Now, I don't know if you know who the IMP are. I didn't know ahead of them as well, but really a global think body, a non-profit organization that have brought together 2,000 different organizations to come up with best global practice in the space, and have collaborated to come up with 16 standard setting organizations and methodologies, etc. And we've decided that that would be a very useful, very appropriate methodology of scoring managers. They tend to do that in 5 dimensions, and 5 dimensions of impact, looking at the what, the who, the how much, the contribution, and the risk. If we go to the next slide, you'll have a look at maybe just slightly more diagrammatic representation of that. And essentially what we do is we take those 5 dimensions and we score every asset manager on that basis. And this is done, let's go to the next slide, at various different levels and various different times. So we, on a quarterly basis, will be monitoring all managers underlying, and we've met many in this particular space, to make sure that they're sending us the data, that we analyze it correctly, we update it, etc. We report this to a oversight committee that we've created. We'll be reporting the impact performance of these funds, not only internally to the committee, but also back to the managers as well, to make sure that they are enhancing what they do. And for follow-up investments on the far right there, we'll only be making those if the managers have indeed made some progress in the impact space. So I think we've come up with a framework which is global, sensible, and I think very practical. In terms of doing this, there are many steps in terms of assessing who to give money to. Pre-investment, obviously you want to do detailed due diligence, and that would not be their old due diligence. An investment due diligence, and in fact an operational due diligence, but you need to include an impact due diligence or screening process as well. There's 5 different aspects we go through. And then post-investment, we want to make sure that we're monitoring these aspects very closely as well. And trustees will need to do this either themselves or utilizing others. So both the monitoring of what managers do, or the funds underlying do, as well as the reporting aspects as well. So let's have a quick look at our Fund of Funds series that we recently launched. Firstly, in terms of objective, we wanted to come up with something that would tick the box for institutional investors in terms of a well-diversified portfolio that really ticks 2 key aspects, both impact and developmental. I've defined both of those underlying. You can have a look at those, but I think there's been enough discussion in the space to understand broadly what we're talking about. But second objective, and I think in many ways as important, we're looking to change the ecosystem for the better. We're looking to be a positive change agent, and in fact to grow the industry, to ensure that we have a wider industry over time that can invest more money, having more positive beneficial impact at the end of the day. And we really do believe that by targeting development outcomes of both the NDP and the SDGs, which we discussed, we can align positive economic growth with tangible socioeconomic impact. And at the end of the day, that's what most of us would like to achieve. So we've decided to go with the 3 key asset classes. In time, we'd like to have a debt fund and an equity fund and a property fund. That's something that would give, investors a wide array of asset classes, match an asset liability model if need be. We're starting with the debt fund, and I'll explain in the next slide why we decided to start with that particular fund. And I provided some level of details to some of the aspects of that fund. For example, liquidity, there'll be a 3-year initial lock-in, but thereafter cash flows will be available on a 6-monthly notice period basis. We also decided to go with a minimum investment of 50 million rand. I say this only to say, because that makes it kind of achievable and investable by smaller funds, which we think are important. So I'm trying to come up with some of the solutions that we've thought long and hard about that would make this more attainable and useful to kind of investors at large, in this case, institutional investors. Next slide. If we look at why have we decided to launch with the impact debt fund first, I think there are a number of reasons. Certainly, it's the area we saw the highest level of interest. It's certainly arguably the most impactful space. It's also a space that tends to fund growth. We've spoken about listed investments and equities. When you sell one equity to another, there's no new growth in the economy. So the concept of additionality, how we provide funding to grow something and do something more, to add to the pot that we have, is a very important aspect. It's also the largest available universe, and has high liquidity underlying. It's self-liquidating. We're playing in debt, fixed income, cash type of space as well. We've come up with our initial manager lineup. They've been assessed, scores, and very much available for investment. In conclusion then, I think this particular area, as we've spoken about all morning, is an exciting area. It's a big opportunity. But as we've said, it does come with a number of challenges. One possible solution is what we've come up with, is a fund of funds approach. It's one that others might wish to consider as well. There's an attractive lineup not only of managers, but complementary ones that we feel at portfolio level do a little bit more than they would do individually, notwithstanding and the added benefits of diversification. We think we can make a real impact. It will be monitored ongoing to ensure that is exactly the case. And as I said, follow-up investments will not be made unless they can be well demonstrated that they've made impact positive progress. To be well constructed with appropriate risk controls. All of these aspects would have to be thought about in whatever kind of approach you decide to take, closely monitored with an appropriate governance structure, and designed to really make a big difference in line with our slogan, to invest with care. I think this would be a sensible, attractive solution. There are aspects that can be taken by trustees, by others to think about it, but also with an ability to make a positive ecosystem change, to grow the country, to grow the industry, to grow this particular space, which, as we all recognize, is just so important. I thank you for your time, and I'll be looking on the chat box for any questions. Thank you.
Thank you, Glenn. I think it's good to know that there are solutions for us as trustees and institutional investors that we can consider should we wish to add to changing the way that we live now and going into the future. I'm now going to hand over to Rizhantu Sitole from Futuregrowth to take us through impact measurement and management. So how do we measure and manage these investments? Over to you, Rizhantu.
Thank you so much, Yvette. Hi, everybody. My name is Rizhantu Sitole. I am an impact investment analyst at Futuregrowth. My role is to ensure that we measure the impact of our investments throughout our deals. I will be taking you through the different approaches to impact measurement and management, which will be reinforcing what some of the speakers have spoken to, especially what Glenn had just spoken to. Some of the frameworks that he mentioned, I'll just touch a bit on them because he has actually spoken to some of them, but then it shows and reaffirms that some of the frameworks that we're using, we're getting to a point where we are using standardized frameworks, which has been a challenge with impact measurement and management. Please let me know if my presentation is showing that side.
We can see it.
Okay. So our agenda items is what I will cover is what is impact measurement and management, and this has been touched on by some of the presenters today and in yesterday's session. I will also be speaking to why are we here? What has been the journey for us to get here? Some of the questions are around impact measurement and management, and just to show the practical evidence of impact measurement and management. It's one thing to talk about impact measurement and management, but how do you put this into practice? And how do you ensure that you are able to show the value that you have created as an investor or an asset owner? I'm sure a lot of us are familiar with this definition from the Global Impact Investment Network, popularly known as the GIN. They define impact measurement and management as one, an ongoing practice of measuring, assessing, and improving impacts on people and the planet. The practice is relevant for enterprises and investors who want to manage the ESG risk, as well as those who also want to contribute positively to global goals. Impact measurement and management is going beyond ESG. It's the step further that now we've assessed the risk. How do we now look at the other factors, and how do we measure and manage this investment as an ongoing continuous process? impact measurement and management is more than data collection. And I think this is the highlight of the slide for me, that when people talk impact measurement and management, we're talking a lot about data. We're talking about showcasing the SDGs. We're talking about all these beautiful colors that you see in a lot of integrated report. But what is the background behind that, right? It's more than just collecting the impact data. Now more than ever, managers of funds that invest in line with ESG principles and thematic investments are being called upon to put forward tangible, measurable, and robust processes to measure impact. And previous speakers have spoken to that. It's not enough to simply say we have deployed S amount in this particular sector without showing the outcome and the impact over time of that investment. There has to be a shift from outputs, which is we've invested so much in this particular sector, to more of reporting outcome. That investment, what has it yielded? Did it yield a number of jobs? Has it yielded a number of affordable housing units, and so forth? So we need to move away from reporting just the outputs of investments to now more reporting on the outcomes and the impact of the investment. And one thing the pandemic has highlighted is that as how investors need to start paying more attention to the social, which has been somehow neglected pre-COVID. There's a lot of interest on.
Sorry to interrupt. Can you stop sharing your screen and start sharing it again? Because some reason it's not moving from slide to slide.
Okay, let me stop sharing. And I'll start sharing again. Jason, maybe you can share for me. I've had issues with it. Maybe can you try sharing on your side, Jason?
Sure, give me a second. Okay, just tell us which slide you're on currently.
I am currently on slide 6. Slide 6.
Correct. Is
Yes.
that good?
Yes.
Perfect.
Thank you so much. As I was saying, there are a few standards and frameworks when it comes to impact measurement and management, which can bring a lot of inconsistency, lack of standardization, and comparability across asset owners and managers. We have seen work, what we have seen work for us at Futuregrowth is to take principles from the different frameworks like the International Finance Corporation, the GIN and IRIS Plus, the SDG reporting framework, and the impact management project's 5 dimensions of impact that Glenn spoke about. The 5 dimensions of impact stand out for us because they bring a holistic approach to impact measurement and management. Glenn has already alluded to the fact that the principles look at the what, the who, the how much, the contribution, and the risk that is occurring at a particular point in time, which is a continuous cycle. What we like about the 5 dimensions of impact from impact management project is that it is showing and reinforcing that this is a cycle. You have a start point, but you have to continuously look at your impact strategy and continuously look at changing this, because if you're looking at your impact thesis, your strategy keeps changing as things keep changing. COVID has highlighted that priorities have changed, and if you keep to one strategy in your impact thesis and you're not looking at what is happening around you, it becomes very difficult for you to be aligned with the priorities of the National Development Plan or the SDGs, just to name a few frameworks. You can move to the next slide, Jason. So I will cover some of the common questions around impact management and how we at Futuregrowth apply these 5 dimensions of impact. We need to understand the experiences of people through our investees and stakeholder consultations, which is informed by an impact thesis and a strategy. Our impact goals and priorities are aligned, as I mentioned earlier, with the priorities of the National Development Plan, which is very much aligned with the Sustainable Development Goals. Around 74% of it is aligned, but obviously the National Development Plan goes on further to look at the South African context. So as an investor, your impact thesis, your impact strategy needs to be very much aligned with the National Development Plan. You don't want to be doing something that is totally different from what the priorities of the country is at a particular time. We communicate our goals with our partners, which are our clients. It's very important to be aligned with your clients, to know that this is what, if they are focused on job creation, you need to be able to showcase that for them. It's about aligning with your different clients to get to a common ground to say, this is what we can measure, and what we can measure is informed, but how we align and listen to our investees. It's very important to engage your investees from the onset. What we've seen work for us is that if you have the process and you're not communicating the intent to your investees, which are the people that are collecting this data for you, it becomes very, very important for you to get buy-in. You need to understand what challenges they might encounter in collecting the information. It's all good and well for us to share all these beautiful templates to say, this is information that we need. We need you to be reporting on this information at a quarterly or a biannual basis. But what are some of the challenges that they might encounter with their beneficiaries in getting the information to you? So you need to engage on them, and you need to engage with them from the onset. What we've seen work for us is we have a guideline of the matrix. We record some of the key metrics that we want each deal to look at, and that has helped because from the onset they know what it is that we're looking for, and they're able to ask if they have questions on certain measurement approaches that we might share with them. Can you please move to the next slide for me, Jason? In this slide, I will show some of the matrix and key performance indicators we use to aggregate and report the information we receive from our investees. We use key performance indicators to standardize our impact measurement across all underlying investee companies to enable us to report in an aggregated AUM level. This is very important because if you have over 300 investees, for example, you need to standardize how you define your indicators. If it's job creation, will they understand job creation as the same thing? Some investees could look or define job creation as a job that has a period of anything from 1 to 2 years. That could be a permanent job. But another investee could look at job creation, for example, as a metric that has a start date but not an end date. So just that example can show you that if you do not have standardized definitions, there could be different interpretations which can then now impact on what you are reporting on. So what we've seen work for us is that if we have key performance indicators, we are able to get the same data because we've defined what those metrics are from the onset, and everybody understands the definition. And there are some investees that obviously it might not be a one-size-fits-all approach. There are some that will come to us and say, we use proxies, like for example, in the agri sector, that we have seasonal workers, we do not have, but we have proxies that we use to define what could be a permanent job. And then that's where that engagement with your investee from the onset becomes very important, because then you now look at that particular deal and see what proxies do they have in place. And when you're reporting, then you now need to account for those proxies to ensure that it's still in line with your other investees' definition of job creation, if we're using that as an example. So job creation is just one of the metrics. We also we have transformation. We also look at SMME supported, but also more specifically, we also look at sector-specific metrics. This enables us to slice and dice the data to give a snapshot per fund, per sector, and at the deal level, when we're also using case study to showcase or illustrate the impact of each investment. My colleague Jason spoke about this earlier, where we're using outcomes from our affordable housing just to show and zoom into that portfolio and sector to say, within affordable housing, how many jobs have we created? How many units have we created? And the jobs that we've created, how many of those jobs are to a certain demographic? How many of those jobs are to women? And how many of those jobs are to youth? The fact of having standardized key performance indicators and matrix allows us to be able to slice and dice and look at each metric and also look at the data at an aggregated AUM level. You can move to the next slide, Jason. This is just an example of what I just spoke to earlier. So we are able to zoom in, and this, I use job creation just to illustrate that it's very important to use those common metrics, because here we're able to take 22 investee companies from different sectors, from the housing, communications, tourism, energy, and other sectors, but we were able to get the same information and aggregate it to be able to show job creation just from one of our funds at a specific point in time. This becomes very important because now when you're getting the data back, the measurement is the same and the social metrics that were used are understood the same. Some of our key outcomes are local economic development. I've already spoken about using job creation as a measure of employment creation and retention. We also look at SMMEs and local value creation, particularly opportunities created for Black SMMEs. We also look at inclusive economic growth, where transformation is one of the metrics where we look at ownership, but not just the scorecard. We also look at skills development, enterprise and supplier development, and gender equality. So this really, really helps, because then now if you look at the slide, this is just one company that we shared our reporting matrix to. We're able to zoom into this particular company and show the SDG alignment and contribution of this particular company, where we were able to show from input, output, outcomes, and the impact of this specific deal in our affordable housing sector. This is the deal level. We are able to move forward and show at a sector level, which is what Jason has shown, and the previous slide was speaking to just job creation, but we are also able to show this information at an aggregated AUM level. You can move to the next slide, Jason, just for another practical example. So this slide talks about one of our reporting frameworks. We've seen that the SDGs is actually quite a nice framework for us to communicate the impact of our funds. It's something that a lot of investors and stakeholders identify with. And here we're able to get to this point because as we're collecting data from each investee, we are able to look at the targets and indicators for that specific deal and how that is linked to the SDGs. Because a lot of reporting around the SDGs, you don't see the background work that comes before it. You all see these beautiful rainbow colors on a lot of reports, but how do you get to align your deals with the SDGs? So we're at a point where we are able, if someone wants to say, show us you're not rainbow washing, how did you get to aligning directly to 10 SDGs across all sectors? We're able to now go back, like the previous slide, that shows that this specific deal in this sector contributes to so many SDGs. And then when we look at it at a cumulative, we're able to say these are our primary SDGs, these are our secondary SDGs, and these are SDGs we have very little impact or alignment with. You can move to the next slide and the one after this. So just as a sum up to what I've been saying and to touch on some of the points that my previous colleagues have spoken to, is that there is no one size fits all to impact measurement and management, but there are fundamental principles that will ensure transparency and help deliver and improve impact. First, we need to understand the experience of people and the environmental impact of our activities. Secondly, we need to define our intentions and limitations to mitigate some of the identified priorities. It's all good and well to have a list of priorities, but there are certain limitations. There is so much that you can do. There are enabling and other factors that are that can hinder whatever that you're trying to do. So it's good from the onset to be able to define and understand what are your limitations. And this can be done using a baseline study to say, yes, when we started with this investment, this is where this investment was, and now this is where they're at. Certain things happen in between, but you are able to show what is your ultimate contribution. We need to also set financial and impact goals and monitor the progress for both concurrently. There's a lot of focus on financial analysis and keeping track of that. And then there is the impact side, which becomes a byproduct. We need to shift from that mindset and start looking at both. And that way it becomes part of the investment process and it's integrated. And it goes back to the saying that you can't manage what you can't measure. If you are not measuring it, you can't manage it. And if there is something that happens like an unintended consequences, because you are not actively looking, you are not able to mitigate those unintended consequences, because that is also part of impact measurement and management that a lot of people don't want to talk about. That through our investments, there could be unintended consequences, and how do we account for that? How do we mitigate for that? I think that's all from my side. Thank you so much. Over to you, Yvette.
Well, thank you. I think it's quite scary, the amount of detail that you can pull through. And I think it'd be quite amazing to know that if we've invested in a certain product, how many jobs were created by simply investing and managing that project going forward. I'm now going to hand over to Simon Howie from 91. He's going to take us through how to invest for just transition and engagement versus exclusion. Over to you, Simon.
Thank you. Let me just display. Right, is that displaying?
Yes, it is, but we also see the notes.
Okay, great. Okay, look, I think let me carry on with these slides as it is, if it is visible. And apologies up front for IT issues. I think what's happened is that it's become a lot easier to do these things from home. And these days when we come into the office, all of a sudden it's more complicated with all the technology. The angle that I'd like to take and talk about is a very practical one. And it is, as at the coalface, dealing with this aspect of sustainable development, thinking about the way that we put money to work. And the starting point for that is well, who are we? And why would we be qualified to share with you our experiences, our very practical experiences of within a team thinking about these issues, making decisions about what is sustainable, what is acceptable, which is the way that we go forward. Well, as a team, there's 25 of us focused on South Africa and Africa credit. We're managing about 90 billion Rand in credit strategies. About 50 billion Rand is in listed and more liquid. And I'll touch on those because there is a place to play in the more listed space in things like infrastructure bonds, etc. But about 40 billion and over that we manage is in private and illiquid credit. And there, as I'll touch on, there is a real opportunity to engage. And the nature of the kind of funds that we manage are very much in this space. So when we look, it's multi-sector, it is South Africa and the whole of Africa, a lot of renewable energy and other power projects, a lot of ports, roads. We invest across communications and telecommunications, selected resources. So really is a multi-sector approach. And then really importantly, I think for this audience is for many, many years, we've had development finance institutions as clients of ours. So you can imagine the kind of journey we've had to go when you have the likes of DFID, which is the development arm of the British government, CDC, also FMO, the Dutch Development Finance Institution, Obvium, all of these kind of clients, as well as our big South African clients and other global clients investing into South Africa and Africa, and very conscious of what is required. So as I say, 25 of us, engineers, chartered accountants, finance people, specialized legal, specialized development impact people, and specialized ESG people, all focused on this space. Now, if we look, at really the sort of case for avoidance, which is a default for many people, and certainly when you speak to people who are in the developed markets, where it's kind of easier for them in some ways, what is the easiest way to show progress at the fund level? And for all of you thinking about your pension funds, what's the easiest way? Well, just exclude more carbon emitters. Any investment that's transgressing ESG principles, leave them out. Include more safe options, clean industries, and easy geographies. And what will happen if you do that is year on year, the numbers look better. The reporting looks better. It looks like you're improving. What's the advantage of this approach? Well, just that, clear, measurable progress. It reduces the capital to companies that are scoring below par. So yes, you're squeezing those companies a little bit, and you can claim that you're moving in the right direction. But what are the disadvantages? Well, the disadvantages is that it reduces the ability to influence over the long term, because you're not that engaged. It ignores the reality of developing markets where companies are often less sophisticated, more growth oriented. They actually need your support. They don't need you to turn their backs on them. They need to get in there, help. Most of them are incredibly receptive to that help. And that's what we found over time. And it certainly favors factors that are easily measurable, making it hard to promote the wider needs of development to sustainability. And that's a tricky one, because we know how important measurability is, and we certainly in our reports and the work we do a lot of measurement. Some of the factors that we've spoken about in previous sessions here, really important, but there's also a softer side, a qualitative side that's got to come in the reports that you do that talk to the softer side of sustainability. That's not quite as easy to measure, but equally as important. So then what are the alternatives we have? Now, we are investors. You have pension funds. We will have a mandate within that. What are the ways we can go ahead? Well, thematic bonds is a really important part of that. Green bonds, other thematic bonds allow companies to finance specific projects. Really important, and we've been a big supporter of these. It's easy, it's efficient. Engagement can be limited. We try and engage in these, and not just in South Africa, but elsewhere. But certainly a part to play. What's harder? Where do you have to roll up your sleeves? Where are most of our resources put, even though it's slightly less assets under management? The directly originated credit, the private and illiquid credit. This requires a lot of commercial and legal expertise. It's often illiquid. Mandates have to allow it. You've got to be very careful of liquidity, make sure it's the right construct, but it does offer the best opportunity for engagement. If we look then at the green sustainable bonds, we have been a big supporter of these. We've helped underwrite a number of them, from names that you know well, through to the affordable housing that TUF does. But also, I've mentioned here some South African ones, very, very active across the continent. It's not just South Africa that needs this focus. We've also been anchor investors in the likes of Acorn Housing in Kenya, Sonatel, Port Dakar, IHS, and HTA, which are tower companies throughout Africa, and also Liquid Telecom. So really getting in. And in many of those cases, when you are an underwriter, you in fact can engage quite a bit. You can get better reporting, you can have side letters, and you can be part of a process that moves these larger entities along in the right direction. Directly originated credit is harder, more rewarding from our perspective. There's more you can do, more engaging. So let's pose a few questions then. What are the rules for deciding if the ESG framework and transition plan is sufficient when you're looking at a private investment? What are the non-negotiables? Who decides if an investment can be classified as sustainable? So really, what are the rules when you go into private credit? Well, firstly, what are the rules for deciding? Well, there are various industry guidelines, papers, and emerging global practice, but there's no specific rules. This is the situation we find ourselves in, and we find people in the team. They say, right, what are the rules? Where's all the guidelines? And we say, well, these are the guidelines that we're formulating. This is moving so quickly, developing so quickly that you have to be in the right forums, getting the right papers, staying up to speed. It is moving incredibly quickly and very dynamic. What is the hard-coded non-negotiables? Well, actually, nothing is hard-coded. That said, of course, when you go into some investments, some are fairly obvious that you're not going to go beyond a certain point, but nothing is actually completely hard-coded at this point. So who decides if a private investment can be classified as sustainable? There isn't really an external provider or adjudicator that signs off, so I guess what I'm saying here is there isn't an easy solution to any of this. It does take hard work. So how to proceed? Well, firstly, investment teams should have suitably qualified, experienced specialists. I think what I'd add to that is you also need a lot of young people who've come through, young people with the right qualifications, who have a passion for it all, who can teach those of us with gray hair. We might have been doing it for a while, but there's still a lot that we can learn. You need the actual specialists, though. We don't in our team try and do our own legal documentation. So we make sure that we've got 2 ESG people properly qualified. We've just employed and is about to join a development impact person, because that's a slightly different set of qualifications. They're more forward-looking, focused on the positive impact. ESG is slightly more focused on risk, on those kind of parameters. You then need a very rigorous applicable ESG and sustainability process. It needs to be properly designed, properly communicated, agreed. Clients need to be aware of it and have signed off. Then your investment people must be trained, because what you don't want to do is have your specialists sitting on another floor in another team, a central resource. They need to be in the team. To invest today, you need multidisciplinary teams, not just finance people. Sitting alongside you as your equals need to be your legal people, your ESG people, your development impact people, and the investment people must be trained up. It's got to be a joint responsibility. There's got to be ownership. There's got to be a culture in your team that this stuff is real and is important. And people who don't buy it, aren't part of the process, are people that are going to battle to be part of teams going forward, certainly in our view. So then, to really leave you with the real dilemmas that we are faced with in our teams, and to show you that it's not so easy, any of this stuff. Here's a nice example, a practical example. On this page, it should be incredibly easy for all of you to turn your back and just walk away. This is a loan to a heavy fuel oil power plant. What could be worse? Well, it could be worse, because the HFO is actually transported on diesel-powered trains. So that is what we're looking at. The investment comes through into the team, and I've anonymized this because there's confidential information. Do you just throw it out, or do you say, well, let's at least have a look at it, have a think about it? So the next set of information you get, right, this power plant is situated in the industrial zone of one of the largest cities in a very stable African country, where development is critical. It's on a good growth path. It needs industrial development. The power supply in the country is not reliable. Industry is on its knees at times. If it doesn't have power, it cannot manufacture, it cannot produce. What does this power plant do? Well, it provides emergency power. The minute the Eskom equivalent power goes off, there's load shedding, whatever, this kicks in and provides a whole industrial zone with power. This plant is the only source of peak power available at short notice. The owner of this plant is a very well-respected business. In fact, it's a fund that looks at the whole of Africa. It's got an exceptional governance track record, and not just governance, also on the environmental side. The parent company has also decommissioned the sister plant. There were 2. The one plant no longer needed, decommissioned as part of a transition plan. This plant is needed for 10 to 15 more years to provide emergency peak power. It will provide less and less power as renewables and other energy sources come into the grid and the grid becomes more stable. It will then be decommissioned. The finance, the 5-year loan is completely covered. It's a really good investment from a guaranteed offtake agreement. So these factors then we look at and say, right, let's engage, because this is interesting. Intuitively, it's a no, but let's engage a little further. You engage further. What do we see? Strict adherence to IFC performance standards. Qualified personnel on the ground who are ensuring compliance with a strict E&S policy, various industry standards across all of the things that you would expect are important. There's also as many initiatives as is possible in that part of the world. Rooftop solar, low energy lighting. All the water used is there's an on-plant treatment facility, all treated before it goes back into the stormwater drainage system. And then a very, very strong transition plan with milestones for not just the owner of the plant, but also for the power utility. So I think with these things, what you can see is this is an example of the kind of debate that you have within a team that then requires a process and a policy. And we have similar debates within the team on things like resources and different sectors within resources. Some resources and some metals are critical components of the new world as we imagine it, whether it's hydrogen or battery cell technology. Other things like aircraft. Do you fund an aircraft or not? Are you contributing to further development in that sector? Is the new aircraft you're funding more fuel efficient, and does it cause the decommissioning of an old aeroplane? So these are all examples of things that you can imagine make things quite tricky and quite complicated. So the conclusion from my side, and I'm purposefully not giving you an answer on the previous investment. You know, we are in the process of looking and thinking about it, looking again at process, talking to clients. How do we get our head around something like that? Now I'll leave it with you to do the same. The answers are often not obvious. There's a real danger that investors find ways to justify any investment. And this line here is just so absolutely critical. It's something, certainly a role within my team to be very careful about. Our management is very careful about. If you leave things too open, surely you can actually justify anything. And there's a real risk in that. So we need to think through that and make sure that we've got the right culture, that what we do is genuine and real. Investment managers have to then develop clear processes in conjunction with clients. Objectives must be very clear, including emphasis. And why do we say emphasis? Emphasis might be different if you're sitting in Sweden versus South Africa, you know, in terms of a more holistic looking at things, in terms of the social side, other people have mentioned. And then goes to the last point, emerging markets may well require a more holistic approach to sustainable development, but we cannot ignore our responsibilities. And therein lies the balance that I think we're all trying to grapple with and trying to work towards. So thank you, and very open to questions.
Thank you, Simon. I think what's become quite clear is how complex some of these investments can be when you think about investing in them, and how you have to really dig into the detail to find out what is behind the project. I see there's no new questions raised, so I'm just going to give each presenter a chance to just in 3 sentences take us through what their view is. So Monica, I'm going to start with you. Where are we going to from here in 3 sentences?
Thank you. Thanks, Yvette. We are going to a place of questioning our providers on what they are doing. We are looking to invest with care, and we are looking to create a South Africa that we all wish to retire in. Thanks.
Well, once again, powerful and really inspiring. Jason, how would we make it real?
I think from my perspective, it's really about asking the right questions. I mean, Simon alluded to the fact that, you know, one can make investments, but it's really not good enough to not actually dig deep and assess the underlying sustainability of that opportunity, and dig deep in terms of getting a sense of what the output is from the impact perspective.
Have to develop our interrogation skills. Nazmira, how will we transition?
I think maybe the way to try and frame the transition part in the overall debate is, you know, we all know the challenges South Africa faces at this point. They are a multitude, and the key ones are the fiscal challenges, the developmental challenges, and then I've talked you through the climate change challenges. But the opportunities in this space, and the opportunities to take advantage of the transition to actually be a positive force for development at this point in time to spur growth. And I think the opportunities for investors to obtain some good returns out of it, to get this marriage of impact and return. But what we need is better measurements, better disclosure, better interrogation, as Jason said. And as a result, you need fund managers that have embedded this in their processes and who think about the impact and the financial returns as side by side, complementary, and not one completely trumping the other.
Thank you. We will have to develop a lot of skills. I see that we've lost Glenn. He can apparently hear us and see us, but he can't comment. So if there's any questions for Glenn, please raise them in the chat, and I'm sure he will respond from there. Are you back, Glenn? No. Okay. Then Rihansu from Futuregrowth, measurement and management, the two challenges out there, in 3 sentences.
To overcome those challenges, we need to be intentional. We need to start looking at both the negative and the positive impact. You can't have one without the other. And we need to improve on and continue on our data management, because if you do not have a good data management system, you won't be able to know what to do with that impact data.
We have to develop our systems to fit with our new investment strategies in the future. Simon, that brings us to you. How would you invest for transition? Simon, you're on mute.
Right, off mute. Yeah, I guess transition is a wonderful word. And the way we think about it is, and we have thought about it, we could offer a product and say, clients, if you care about sustainability, care about the world, go into this product. The preference is actually to transition our core funds. So from our side, our core private and illiquid strategies, transition them to be sustainable strategies over time with our clients, moving in that direction. And that's the way we create real impact, not by launching small little other funds.
Thank you. I see there's a question from Radesh for you, Simon. Interesting example on HFO scenario for financial services and retirement funds. Outcomes are paramount nowadays. So that also plays a role in accessing such cases. Do you agree?
Absolutely. The bigger outcome is critical. Looking at the whole picture, thinking about transition. I think Nazmira really painted a really interesting picture of the way we need to think holistically about these things, not get caught too much in one rabbit hole, look at it carefully, but at the same time, we need our standards.
I don't see any other further questions. So from my side, just thank you, everyone. I think we've learned a lot. We've learned what is in. We've learned that the goal is to make a difference and still provide our members with their investment returns. We've learned that it must be measured and that we carefully have to choose our products and we really have to interrogate. We've learned that we must ask the questions from our consultants, our asset managers, everyone that we deal with. So from my side, thank you, everyone. We'll still be around for a few minutes. So if there's any questions, please raise them in the chat box and we will respond from there. Thank you, everyone. Have a wonderful afternoon. I see there's one question in the chat box that came through. Namira, good point regarding Germany and the auto industry. Terry said, great session, everyone. Thank you. Another comment, this was most enlightening and engaging session. Thank you for all your panelists for sharing your experience with us. It is greatly appreciated. Thank you, everyone. You will see at 12 o'clock, you can reconvene in the conference for solution room 8 or 9. Ridwan, I'm glad you enjoyed the session. Thank you. I see there's one last comment that came through. Once again, thanking all the panelists for your thought-provoking information that helps us to navigate through this transitioning period with our clients. I'm now going to end the broadcast. I trust that you have a wonderful afternoon further. Goodbye.